And joining us on the initial impact on the markets across all asset classes, Japhet Tantiango, Research Manager at Philstocks Financial. Good seeing you again, Japhet. Welcome back to the program.
Good morning, Ma'am Kathy, and thank you very much for inviting me.
All right, so it looks like risk off across all asset classes, but where's money running off to?
We've checked the opening numbers in the local market today, and as you can see, the general market is down. In fact, it plunged by more than 2%. But if you're going to look at it, there are some stocks that are outperforming. For example, you have the likes of our gold miners, you have Felix Mining, you have Apex Mining gaining at the opening trade. You also have our oil retailers, the likes of Petron and Shell. They're also posting gains in this early morning. And that tells you, that gives you a picture of where investors are running to. Number one, with the geopolitical tension that's happening, investors are going for safe havens, one of which is gold. And so moving forward, we may see a rise in gold prices as well as in the price of gold mining stocks. At the same time, we're seeing a rise in oil prices. And so investors are considering oil retailers as winners on this one. And finally, moving forward, we may see also, we may also see demand in, in treasuries and bonds and fixed income assets.
So are
So
we
it's
going to
really
be on
going
a
to be
holding
more
pattern
of
here? What are you now advising investors? Should they just park their money there for now or for the long haul?
well, of course, with respect to all that's happening right now, yes, we advise investors to somehow invest more cautiously. First, we should focus on those that are at an advantage given what's happening right now. So again, go for gold, go for oil retailers. Yes, go also for safe havens for the fixed income securities. We can still go for stocks, but we'll have to do it cautiously. As of the moment, of course, we are not advised to do so given that the market is declining. Let's wait for the market to find a solid support where it will consolidate. And once that happens, then we can pick up shares.
Right, because it's all sentiment driven now. But when we look at the fundamentals, I
Mhm.
know that you've warned that the Philippines will feel this mainly through inflation and the peso. And we've seen the
Yes.
peso drop at the open. Between those two channels, which do you think is the more immediate concern for us right now and why?
Um, well, with respect to immediate, I believe it will be the local currency. Because inflation. Because if we're going to look at it on a market standpoint, the peso quickly adjusts. I mean, you're going to look at prices. If you're going to look at the local currency today, local currency has already depreciated because of what's happening because of what's happening offshore. And so primary or first concern would be the local currency. But of course, once oil prices become persistently high because of this war or this tension, then it's expected to reflect on inflation, and inflation in turn is going to be the long run concern.
And that's going to be quite a concern for the Banco Central, I would presume. Would that change the trajectory of the rate cutting or even maybe a pause, maybe considered?
Well, with respect to the situation at hand, yes. Um, if you're going to look at if you're going to look at Okay, so first, if you're going to let me give you a little bit of history. We can check what happened in 2018. In 2018, we've also experienced the same. We've had oil prices rising because of factors from offshore plus the train law being implemented. So we saw a spike back then. At the same time, we saw the peso depreciating in 2018, and I believe that's what could happen again this year if this war is going to prolong or if it's going to persist. However, the problem there is that of course, inflation is supply side. I mean, the oil price, it's a shock to inflation, so it's going to be more of a supply side. It's something that even if the BSP raises policy rates, it won't have an immediate effect. Though ultimately, there's still the possibility that the BSP will pause or even raise policy rates if if oil prices tend to be persistently high, because it will have second round effects. It will have impacts on inflation expectations, and this is what the BSP doesn't want to happen. And so moving forward, yes, if this becomes persistently high, BSP may pause. It may even raise policy rates.
All right, a lot going for the transmission of global oil prices being a lot higher for a longer period of time. Thank you for your insights, Japhet Tantiango of Philstocks Financial.